Rajat, good having you. Thanks so much for joining in. What continues to drive your industry-leading loan and NI growth of 29%?
Well, if you look at our loan growth, I will divide our loan growth in two parts. One number you see is the growth which you see is year on year, which is clearly a 29% growth number. But the part which I would also want to put into this discussion is the growth between the September and the June end position. That growth actually has been only 1%. So the recent growth trends have been a little bit weakish, but the year-on-year growth trends have been strong. Is because that growth had already happened in the second half of last year or thereabouts. So this is a little bit of a comparison of where we were about same time last year and where we are now, and how have we come along the way. So as you will know, the Indian lending business is also a little seasonal, and you will see more growth in the second half of the year and less growth in the first half of the year. First half of the year is also the period from April to September that has very less agricultural produce, for example. So the crop season sets in only now. There is a element of seasonality of both consumption and production in the country, and you should see growth following that trajectory as well. Having said that, you would also recall that the bank had raised capital in the month of June of 2014, which also gave bank strong reasons to grow. There have been many reasons for us to look at growth all over again, because we have not been a main part of the problems that many banks are currently witnessing, whether it is the infrastructure sector or others. Bank is growing more into retail and SME. That has been our of late last couple of years strategy to seek share of loan growth. And it's a combination of all these factors where the bank is continuing to deliver higher loan growth than the peers.
Right. And are you confident of maintaining similar run rate of high 20s going by a favorable retail and SME mix as well? I mean, any challenges that you're seeing at an industry level?
Sure. So the fact that our growth rates can continue to be higher, among others, is also that we are not the largest bank. So we have a lower burden of size. Our loan book is about 80,000 crores, which is, I would say, 1.25% of the market share of the Indian banking sector. We are also adding a new dimension to our loan growth, which is the overseas operations, among others. So we have commissioned our international banking unit in this month itself, and we made separate announcements for that. We are increasingly focusing on retail and SME, like you mentioned. There is now a 700 plus branch distribution behind the bank strategies. We are getting more into retail products. We are launching credit cards early part of next financial year. Separately, we are also looking at investment products, which we can discuss later. So the growth being higher than industry is clearly something that the bank can deliver. Naturally, there is going to be a strong strategy that will support it. We have to manage our risks well, like we have been managing over the last many years, 11 years or so of the bank's current history of operations. So there is a reason for us to believe that we will deliver higher loan growth than industry averages. We are not weighed down by some of the current issues I was mentioning. In fact, today there are more opportunities. We have been focusing, I'll just take a case in point, in the energy sector, on the renewable energy sector. When many banks are worrying about, let's say, the historical situations in the thermal based sector, we are finding new opportunities in the renewable energy sector, and the sector is doing pretty well. So there will be opportunities, and at our size, which is, I would say, is moderate, it's not large, we can still find good enough growth opportunities which are profitable and also offer us enough cross-sell opportunity.
You've not sold any assets to ARCs for the last 4 quarters, nor refinanced any loan through 525 route as well. How are you different from the others here?
The overall position on the credit quality, other than NPAs for the bank, continues to be nil effectively in this quarter. So yes, as you have noted, we have not made any sales to the ARCs, nor have we made any sales for the last 4 quarters. Neither do we have plans to do any sales. So it is not we want to resolve our NPAs ourselves as the mainstay. We could resort to an ARC sale in a remote situation where it is clearly better that it needs debt aggregation, and an ARC is in a better position to resolve the underlying asset, which is unlikely in our scenario, which also brings me to the next situation, which is about 525. The bank has not done any 525 refinancing because 525 is typically meant for existing banks to refinance their loans. When a bank refinances another bank, it is classically called refinancing. 525 is when the same banks can get together and do a 525 on the existing borrowing. So the reason bank has not done much of this, or none actually in the current quarter or in our history, is because we are not in those situations which require 525. So it has to be looked at in relation to where the bank's positions is.
Right. Well, Rajat, also focus on retail banking, strong but calibrated branch expansion has taken your CASA above 25% for the first time in about 11 years since inception. I'm sure you're looking to achieve the next milestone faster, and what would that be?
Well, the efforts on retail banking continue, and you will see many more developments from the bank, both on the liability sides as well as on the asset side. Our CASA performance has been very encouraging. Thank you for your compliments on that. The bank was at about a 10% CASA position about 4 years ago. It has now ratcheted to 25.5%. The plan now is to take the CASA position as a percentage of deposits to 40% over the next 4.5 years. So by 2020, we should be nudging the 40% number. The bank is also feeling confident on the CASA side to take pricing reductions. So you would have also noted about a couple of weeks ago, we have announced a reduction in the interest rates that we pay on our savings account deposits from 7% to 6%. So overall, there is enough and growing confidence that the retail business is taking good shape. It is also supported now by 700 branches. We are getting ready to put another 1,800 branches over the next 4 or 5 years to support it. So there is investments also which continues to come in. You will also see that our costs continue to grow nicely. We are hiring at a good pace to support our increasing franchise, and a lot of the hiring is going in retail. In fact, almost all of the hiring is going in retail. We have set ourselves well in the corporate businesses, and we are now finding inroads in the retail business as well. So the growth expectation that you should have from us should be in the mid-20s, maybe mid to high 20s as far as loan and deposit growth is concerned. Some more, some less. In some years, we have to also adjust to the opportunity. But the bank is also positioned well on size. We are not too small, we are not too large, that we will be weighed down either by a lack of distribution or by our legacy. So it's actually quite a good evolutionary sort of sweet spot for the bank, and we are feeling very excited about it.
Okay, Rajat, we'll leave it at that. Thanks so much for taking the time out and joining us and giving us that perspective.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.